Welcome back to the channel. Today, we're tackling the billion-dollar question, or perhaps the trillion-dollar question that's on every investor's mind. What is Bitcoin's next move? We're staring down the barrel of 2025, a year that many believe could be pivotal, a year that could define the next era of digital assets. Will we see a parabolic surge that mints a new generation of millionaires? Or are we standing on a cliff's edge, about to witness a correction that shakes the market to its core? The truth is, the signals are mixed, the noise is deafening, and navigating this landscape requires a clear, level-headed perspective. That's exactly what we're going to build today. But before we dive deep into the charts, the sentiment, and the fundamental drivers shaping Bitcoin's destiny, I need to be absolutely crystal clear. This video is for informational and educational purposes only. I am not a financial advisor, and nothing I say should be construed as financial advice. The cryptocurrency market is notoriously volatile and carries significant risk. You should always do your own extensive research and consult with a qualified professional before making any investment decisions. Your capital is at risk. Now, with that important disclaimer out of the way, let's get into it. To truly understand where we might be going, we first have to understand where we are right now. The current market is a fascinating battleground of competing narratives. If you were to take the temperature of the market today, you'd find it's a swirling mix of unbridled optimism, cautious neutrality, and deep-seated fear. So let's break down these three dominant sentiments, because one of them will ultimately dictate the trend for 2025. First, let's talk about the super cycle bulls. This is the camp that believes we are on the cusp of an unprecedented bull run, one that will dwarf everything we've seen before. Their argument is built on a few powerful pillars. The first and most significant is the Bitcoin halving. 2024 halving event did exactly what it was programmed to do. It cut the new supply of Bitcoin being created in half. Historically, the full market impact of a halving isn't felt immediately. It's a slow-burning supply shock. It typically takes 12 to 18 months for the supply constriction to translate into parabolic price increases. If history rhymes, and it often does in this market, the period from mid-minus 2024 into late 2025 is the prime window for this effect to take hold. Less new Bitcoin is entering the market, while demand, as we'll see, is potentially exploding. This leads to the second pillar of the bullish argument, institutional adoption. The launch of spot Bitcoin ETFs in the United States was a watershed moment. It wasn't just a news headline, it was the opening of a financial superhighway connecting Wall Street's vast ocean of capital directly to Bitcoin. For the first time, major financial institutions, pension funds, and asset managers can gain exposure to Bitcoin with the click of a button without the complexities of self-custody. We are still in the early innings of this integration. As more platforms approve these ETFs and more advisors become comfortable recommending them to clients, we could see a steady, relentless wave of demand that the market has never experienced before. The bulls argue this isn't a one-time pump, it's a fundamental repricing of the asset as it cements its place as a legitimate, investable store of value in the global financial system. They are not just buying Bitcoin, they are buying a piece of what they believe is the future of money. The third bullish pillar is the macroeconomic environment. For the past couple of years, central banks around the world have been tightening their belts, raising interest rates to combat inflation. This makes holding cash more attractive and speculative assets like Bitcoin less so. However, the narrative is beginning to shift. With inflation showing signs of cooling, the conversation is moving towards potential interest rate cuts. When rates go down, money looks for a new home, a place where it can generate returns. Historically, this easy money environment is like rocket fuel for assets like Bitcoin and stocks. If central banks, particularly the US Federal Reserve, begin to pivot and cut rates in 2025, it could unleash a torrent of liquidity into the market, lifting all boats, with Bitcoin, as the apex crypto asset, potentially being lifted the highest. So to summarize the bullish case, a programmed supply shock from the halving, coupled with an unprecedented demand shock from institutional ETFs, all potentially supercharged by a favorable shift in global monetary policy. For the bulls, it's not a question of asterisk if asterisk Bitcoin will reach new all-time highs, but asterisk how high asterisk it will go, with many whispering targets of $150, $200, or even $250,000 per coin. Now, let's put on a different hat and look at the world through the eyes of the bears. Their perspective is just as important to understand, as it provides the necessary counterbalance and helps us identify the risks. The primary argument for the bearish case is regulation. The crypto industry has largely grown up in a regulatory grey area. Bears believe that party is coming to an end. Governments and regulatory bodies like the SEC are taking a much closer look at the space. The fear is that a sudden, heavy-handed regulatory crackdown could stifle innovation and scare away investors. This could come in many forms: stringent rules on exchanges, the classification of certain assets as securities, or even restrictions on self-custody. The ETF approval was a positive step, but it also brought Bitcoin further into the regulated world, making it more susceptible to the whims of policymakers. A single piece of negative legislation out of a major economy could send a shockwave of fear through the market. The second bearish pillar is the macroeconomic risk, but from the opposite perspective. What if inflation proves to be stickier than expected? What if the economy tips into a deep recession? If that happens, the expected interest rate cuts might not materialize. In a true risk-off environment, where people are losing their jobs and businesses are failing, investors tend to flee to safety. They sell their stocks, they sell their crypto, and they hoard cash. In this scenario, Bitcoin's narrative as digital gold would face its ultimate test. Would it act as a safe haven, or would it be sold off just like other tech stocks and speculative assets? The bears argue it would be the latter, leading to a significant price decline as liquidity dries up. The third bearish point is a technical and sentiment-based one, the sell the news phenomenon. The market is driven by narratives and expectations. For over a year, the two biggest narratives were the halving and the ETFs. Now that both have happened, what's the next big catalyst? Bears argue that the price run-up we've seen has already priced in all the good news. Without a new, powerful narrative to pull the market higher, we could see momentum wane. The excitement could fade, leading to a prolonged period of profit-taking and price decline as early investors cash out, leaving latecomers holding the bag. It's the classic market cycle of hype peak and disillusionment. The bears believe we could be much closer to that peak than the bulls are willing to admit. Finally, we have the third camp, which is perhaps the most pragmatic, the neutral sideways shoppers. These analysts believe that 2025 might not be a year of explosive moves in either direction. Instead, they foresee a prolonged period of consolidation. Their argument is that the bulls and the bears are both making valid points, creating a powerful equilibrium. The institutional demand from ETFs provides a strong price floor, preventing a catastrophic crash. Every time the price dips, large buys step in, seeing it as a discount. However, the regulatory uncertainty and macroeconomic headwinds create a strong ceiling, preventing a parabolic breakout. Every time the price rallies, long-term holders and nervous investors take profits, pushing it back down. The result is a market that trades within a wide but defined range. Think of it as the market taking a deep breath and digesting the massive moves of the previous years. This period of consolidation, while frustrating for impatient traders, is actually a healthy sign for the long term. It shakes out the weak hands, allows for strong support and resistance levels to be built, and lays the foundation for the next sustainable trend, whichever direction that may be. A year of sideways price action would allow the real-world adoption of Bitcoin to catch up with the speculative valuation, creating a more stable and mature asset class. So, we have the bulls dreaming of a super cycle, the bears warning of a deep correction, and the neutrals preparing for a year of consolidation. How do we cut through these narratives and find some objective truths? This is where we turn to the charts. Technical analysis isn't a crystal ball, but it is a powerful tool for understanding market structure, identifying key levels, and managing risk. Let's imagine we have the Bitcoin weekly chart open in front of us. This is the high-level view, filtering out the daily noise and showing us the major trends. The first thing we look at are the major moving averages, specifically the 50-week and the 200-week. 200-week moving average is often considered the ultimate bedrock of a Bitcoin bull market. Historically, buying Bitcoin at or near the 200-week moving average has been an incredibly profitable long-term strategy. It represents the average price over the last 4 years and acts as a final line in the sand. As long as we are trading comfortably above it, the long-term trend remains structurally bullish. A sustained break below this line would be a major red flag, lending significant weight to the bearish case. The 50-week moving average is our medium-term trend indicator. When the price is above it and the 50-week itself is sloping upwards, it confirms we are in a healthy uptrend. The interplay between the 50-week and the 200-week is also crucial. The golden cross, where the 50-week crosses above the 200-week, is a classic long-term bullish signal. Conversely, a death cross where it crosses below signals a potential long-term bear market. Observing where these moving averages are headed in 2025 will give us a huge clue about the market's underlying strength. Next, we must identify our key horizontal support and resistance levels. The most important level on the entire chart is now the previous all-time high from the 2021 cycle, around $69,000. This is a massive psychological and technical zone. Old resistance, once broken, becomes new support. For the bullish case to remain fully intact, we need to see Bitcoin establish the $69,000 level as a solid floor. Dips to this level that get bought up quickly would be an incredibly strong signal showing that the market has accepted the old peak as the new base. If we were to fall below it and stay below it for multiple weeks, it would be a sign of weakness, suggesting that the breakout was a fake out and lending credibility to the neutral or bearish scenarios. Above us, the resistance is less defined as we earn price discovery. However, we can use tools like Fibonacci extensions, measured from the previous cycle's high and low to project potential targets. These are not guarantees, but they represent mathematically significant levels where traders might look to take profits. Common extension levels might point towards targets like 90,000, 120,000, and the big psychological number of $150,000. As we approach these levels, we should expect turbulence and potential pullbacks. Finally, we look at momentum indicators like the Relative Strength Index, or RSI. The RSI measures the speed and change of price movements on a scale of 0 to 100. It helps us identify overbought and oversold conditions. A reading above 70 is considered overbought, and a reading below 30 is oversold. On the weekly chart, when the RSI gets into the high 80s or 90s, it's historically been a signal that the market is overheated and a major top is near. Conversely, a weekly RSI dipping into the 20s or low 30s is often marked the bottom of a bear market. Monitoring the RSI in 2025 will help us gauge the sentiment. If we are making new price highs but the RSI is failing to make a new high, this is called bearish divergence, and it's a warning sign that the upward momentum is fading. So, let's put this all together into a forward-looking statement for 2025. What is the most likely path for Bitcoin? While the short term is incredibly difficult to predict, the confluence of the post-halving supply shock and the institutional ETF demand provides a fundamental tailwind that is unlike anything we have seen in previous cycles. The sheer scale of capital that can now access Bitcoin is a game changer. For this reason, my personal long-term perspective leans bullish. I believe the path of least resistance is upwards. However, this does not mean it will be a straight line. The path to new highs will likely be volatile and fraught with deep, gut-wrenching corrections. The bearish arguments around regulation and macroeconomics are real and cannot be ignored. We will almost certainly experience pullbacks of 20, 30, or even 40% along the way. These are not bugs, they are features of the Bitcoin bull market. They are designed to shake your conviction and transfer assets from the impatient to the patient. Therefore, the most probable scenario for 2025 is a 2 steps forward, 1 step back uptrend. We will likely see the market push up towards this Fibonacci extension targets, perhaps testing the psychological $100,000 level. This will be met with intense excitement and media fanfare. Following that, we could see a sharp correction as early investors take profits, potentially retesting the old all-time high of $69,000 as support. The key will be how the market reacts at that support level. A strong bounce would confirm the bull thesis and set the stage for the next leg up, targeting a cycle top somewhere between $120,000 and $180,000 by late 2025 or early 2026. This is not a guarantee, but a framework for thinking about the year ahead. The most important thing for any investor is not to predict the future perfectly, but to have a plan. Know your thesis. Why do you own Bitcoin? Is it a short-term trade or a long-term investment in a new technology? If you are a long-term believer, a strategy like dollar cost averaging or DCA can be incredibly powerful. By investing a fixed amount of money at regular intervals, you smooth out the volatility and reduce the risk of buying the top. You buy more coins when the price is low and fewer when it is high. It is also crucial to manage your risk. Never invest more than you are willing to lose. As the price moves up, consider taking some profits off the table. You can never go broke taking profits. Having a predefined exit strategy, whether it's based on price targets or a time frame, can help you avoid getting caught up in the euphoria at the top and the despair at the bottom. Ultimately, beyond the charts and the short-term price movements, it's important to remember what Bitcoin represents. It's the first scarce, digital, decentralized asset in human history. It's a technological breakthrough in peer-to-peer electronic cash, and a potential check on the inflationary policies of central banks worldwide. Whether 2025 brings us to 50,000 or 150,000, the underlying network continues to operate, processing transactions and securing the blockchain 24/7, just as it has for over a decade. The question for every investor is how to position themselves for the next chapter in this incredible story. By understanding the competing sentiments, analyzing the key technical levels, and having a robust and emotional strategy, you can be prepared for whatever move Bitcoin makes next. Thanks for joining me on this deep dive. I'm incredibly curious to hear your thoughts. Are you a bull, a bear, or do you think we're in for a year of sideways chop? Drop your price targets and your reasoning in the comments below. Let's have a discussion. And if you found this analysis valuable, please consider giving this video a like and subscribing to the channel for more content like this. It really helps us grow and continue to provide clear, no hype analysis of the crypto markets. Stay safe, stay informed, and I'll see you in the next one.